Hello, good day. Welcome to this special Q&A session for financial modeling with Excel. This video is created in response to inquiry from students. Instead, I'm very happy to receive inquiry from students because it shows that they are learning and thinking. When I believe the question is relevant to other students learning as well, I will create a short video to explain for the benefit of everybody at one go. You are still welcome to post me for follow-up inquiry if you cannot understand after watching this video. Let's start. Let me repeat the background story. In this example, a firm is considering purchasing manufacturing equipment in the amount of 700,000. Wow, that is huge amount of money. The lifespan of the equipment is 7 years, and the firm uses straight-line depreciation with no terminal value. No terminal value means no salvage value. You cannot sell the equipment for any value at the end of 7 years. The estimated income from the equipment is 300,000 for the next 7 years. The estimated operating expense is 150,000 for the next 7 years too. The firms incur a tax rate of 40% and the firm's discount rate is 11%. This question requires students to calculate the NPV and IRR. The student also need to answer what is the minimum annual income before tax in which the firm should invest in the equipment. And students need to use Excel function GoSig to solve this problem. As you can see from the spreadsheet, I have typed the input from the question here in the gray cells. It is always a good habit to separate the input and the output. Here is my output. Alright, I'm going to start with the calculation. Equipment cost is 700,000. It is a cash outflow, therefore I will type equal negative, point the input here, enter. Income is 300,000 per year for the next 7 years. Therefore, I will type equal, point the income. Alright, I'm going to type F4, alright, to fix the reference point. Enter. I fix the reference point because later I can drag across easily. I can copy and paste the answer easily across the first year to the 7 years. Alright, cost of goods sold is equal negative of 150,000. Again, I press F4 to fix the reference cell, enter. Alright, then I put my cursor here and drag all the way to year 7. Depreciation is actually based on straight line method, whereby the yearly depreciation is equals to 700,000 divided by 7 years. Alright, again I'm going to fix the reference cell by typing F4. Alright, and I put a negative sign because depreciation is an expense. Enter, and this is the answer, and I can just drag across. Next, I'm going to calculate profit before tax. I need to sum up the income, cost of goods sold, and depreciation. Therefore, I type equal SUM, open bracket, highlight the cell above, close bracket, enter, alright, and drag across. Let's continue with the calculation of tax, profit before tax, and cash flow. This time, I will use a slightly different style. I will do it vertically. I'm going to calculate the tax here. Tax rate is 40%. Therefore, I type equal profit before tax multiply with tax rate. Okay? And fix the reference cells for the tax rate. Enter. Profit after tax is actually equal profit before tax minus the tax. All right. We need to add back depreciation because depreciation is a non-cash item. All right. It would reduce the cash flow of the business. Therefore, I type equal and I point the depreciation here, but I put a negative sign. Okay? Enter. After that, the cash flow is actually equal the summation of these two figures, profit after tax plus depreciation. Enter. That is the answer. I can highlight here, all right, highlight the four cells and drag across. You see the answer will appear by itself. Okay, and the reference cell will also change accordingly if you don't fix the cell. But if you have fixed the cell, all right, the reference cell won't change. For example, the tax rate, it will always refer back to 40%, even though the cell is moved to the left. Okay, don't forget there is a cash flow here. All right, I shall type equal this cash flow. Next, I'm going to calculate the NPV and IRR. I shall type equal NPV, open bracket, point the discount rate of 11%, comma, highlight the cash flow from year 1 to year 7. Remember, we should not highlight the cash flow in year 0. This is because the NPV function in Excel is programmed in such a way that it does not analyze cash flow 0. The analysis and calculation start from year 1. But I cannot forget about cash flow in year 0. Therefore, I shall type add, all right, and point the cash flow in year 0. Enter. This is the answer for net present value. As you can see here, net present value is negative, so we should not accept the investment project. Next, I'm going to calculate internal rate of return. I shall type equal IRR, open bracket, highlight the value from year 0 to year 7. Close bracket, enter, and the answer is 7.025%. As you can see here, the IRR is lower than the cost of capital, or the discount rate of 11%. Therefore, we should not consider the project too. Next, I will try to answer question number 2. What is the minimum annual income in which the firm should invest in the equipment? Currently, the annual income is 300,000, which is too low and generates a negative NPV. This means the annual income should increase until NPV is at least 0. We are going to learn one very interesting function in Excel called goal seek. If you point data, what if analysis, you will see goal seek here. All right, I shall select goal seek. Okay, then I would set cell. I'm going to point NPV, all right, to value of 0, all right, by changing the cell of income here. Click OK. All right, and you see the NPV is 0. This means the company need to have an income of at least 330,918 dollars in order to invest in the equipment. We can also think about what if the company cannot increase the annual income and the annual income remains at 300,000. All right. Is there a possibility to reduce the cost of the equipment so that the NPV is 0? We can use goal seek again. We go to data. What if analysis? Goal seek. This time we set cell to set cell of NPV. All right, point the cell of NPV to value 0. Okay, by changing the equipment cost. Click OK. All right. And you have the value of the equipment cost as 580,000, $580,374. This means if the equipment cost is cheaper, all right, lower than 700,000, all right, at least at 580, 374, all right, then the NPV is zero and the IRR is same as the discount rate of 11%. We have come to the end of this Q&A session. Please remember, you are most welcome to post me any question or write an email to me if you still cannot understand. See you. Have a nice day. Goodbye.